Welcome to Charting the Markets on this Wednesday, the 4th of January. As we look out to the rest of the month, it's an opportunity perhaps maybe to start to look at ways to engage with trading opportunities for the year ahead. Let's catch up now with our guest for the next 15 minutes. It's Serge Berger from thesteadytrader.com. He joins us now on the line from Davos. Serge, first of all, welcome and a happy new year to you. You're a regular guest and we appreciate your input on this, but let's start off the new year with a celebration of the new year ahead and say to you, happy new year anyway to start off with.
Yeah, likewise. Thank you, Jeremy. Great to be here. Happy New Year. Let's hope that 2023 is going to be a smidge more, a smidge easier than 2022 for the markets as well.
Yeah, well, how do we look at a new year? I mean, do we wipe the slate clean and say, look, we're looking ahead, or do we look at a new strategy? What's the way in which you look at these markets as a trader from January onwards?
It's somewhat ironic that we're playing the calendar year because the markets don't really care whether it's January, but it is the game we have to play. I think what I always tell our clients, whether it's on the investment management side or on the subscription side, I think January is a tricky month. And that basically spans across the asset classes, whether it's equities, commodities, currencies, you name it. It's a challenging month, and it's largely because you have multiple cross currents. You have positioning, flows, inflows from insurance companies, pension funds, all that kind of stuff. So that can really quickly distort, sort of fundamentals. Then you have earnings season for equities, which kicks off later in the month. So it tends to be quite tricky. And so I always tell people, listen, if you're going to start, if you have a New Year's resolution that makes you a more self-directed trader and investor, January is a tough month to kind of overindulge yourself. I think taking it slower, being more selective, smaller position size, and really just being patient, I think, is important.
Yeah, well, let's pick up on a couple of themes that we continue to monitor as we start out on this new year. One of them is, of course, this dollar move. And the dollar is moving perhaps maybe most against the Japanese yen. The move that we've seen has affected, given us yen strength, but at the same time, of course, it gives us Nikkei negative because of this inverse correlation between the two. How are we trading the dollar yen at the moment? Are you satisfied that we're happy below 130, which is what we achieved yesterday?
Right. So if we look at dollar yen we have a trend following algorithm we call the market rover. If you look at that chart right there, that's the green background color. You can see that green background color fired off at some point all the way back in, when was that? In 2021 in the summer. And that's been going well, but we're now in a neutral trend. So we're going through what's called a phase transition. So we've had a really strong bullish trend, the green background color. And now we've got this black background color. It basically means we're kind of in no man's land. I do think ultimately we will have another rally in dollar yen. This was an important move, and obviously we're going to have a new person at the helm later on this year, I believe. And so I think they're kind of getting the markets prepared for that. But ultimately, I think we'll have another rally in the dollar. So dollar yen goes somewhat higher, maybe a lower high. Then we'll get a probably more sustainable move lower. For all the reasons that people know. One is inflation, structural issues, all those kinds of things with dollar yen. So I would probably be careful being short here. It doesn't take a lot for the dollar to start moving again. Get dollar yen back up to 140 wouldn't be that hard. And then probably see if we can re-leg into some shorts.
Yeah, in amongst the dollar trades, we've also seen some interesting moves against the Aussie. This is the Aussie against the US dollar. I noticed actually today that we've got the Aussie above the 200-day moving average. Is that significant in your book?
It's somewhat significant. And so, I mean, it depends how you want to look at it, but I'm going to look at it with Aussie dollar the way you quoted it. You've got that 200-day moving average. Now, we'll say with currencies, I think it's always difficult to play the 200-day or any moving average really specifically because they're that volatile, particularly a commodity related currency pair. But obviously there is some history here. We've seen this 200-day moving average, which is the red line on the screen. It's been holding as resistance, but you can get breakout fakeouts like we had, for example, in the spring of last year. Now here too, I would probably say there's two things. There is the tendency for the dollar to have another rally, the US dollar, which would basically speak for dollar, Aussie dollar, to kind of find resistance here. Maybe go lower a bit. And then on that second, or maybe it'll be the third or fourth try to break above it as ultimately commodities. I think we're in a commodities super cycle. So I think the commodity-based currencies will probably go higher again. So I'm not sure I'm willing to chase the breakout here. But I do think if we go a bit deeper into 2023, this will become an interesting story.
Yeah. One of the other themes I want to talk about, and that is what we've spoken before, is about this seemingly move away from techs as we see interest rate rises. We've got inflation rampant, and techs are very much on the back foot. Is that a theme you're taking through into this year as well?
Well, I think technology stocks, and I'm just going to bring up the chart of Apple here for reference points on the weekly chart, just to kind of have something to talk about. But I think when it comes to technology stocks, we are likely going to see a pretty significant rally at some point in 2023. Maybe that's as early as the second quarter. Maybe we have to wait until the second half. And it'll largely be once the central banks, and this is particularly the Fed, will become less hawkish. They don't have to totally flip the script and become dovish and start cutting rates. Although that might be in the cards later in the year, just less hawkish. And I think that will ultimately bring a pretty big bid into this tech stocks. Now, not all tech is the same. Some of them make good money like Apple. Some of them are never going to make money and going to go out of business. So I think we have to distinguish between some sort of a snapback trade. You look at a stock like PayPal or something like that, or even the ARK ETFs. I mean, some of these things can easily rally 30, 40, 50% on some sort of a Fed becoming less hawkish. But I think ultimately, once we get past that initial point, then you want to start looking for quality again. And I would love to see Apple get down towards about, $80, $90, which technically kind of makes sense as well. We were starting to break, some pretty clear levels here. Now we can bounce a bit back and forth here first before we go lower. That makes a lot of sense to me, more near term. But ultimately, going below $100 towards $80, $90, I think is kind of what's in the cards for Apple. I think Tesla is already out in front of that.
Well, let's talk about Tesla, because this is another stock that's been really roiled by what's going on. And I think both these stocks are actually affected by what's happening in China. Fundamentally, we don't want to talk too much about the fundamentals, I know, but this is behind some of the downside that we've seen. And Tesla also has a headwind in as much as Elon Musk, of course, his feet are very much under the Twitter desk rather than the Tesla desk at the moment. But technically, Tesla is just continuing to take out these lows.
Yeah, so I mean, I think we can look at the fundamentals. We can take those into account, and there's a lot of reasons why the stock probably shouldn't have never been traded where it was. There's a lot of headwinds when it comes to building up their gigafactories, in Europe, for example, with electricity shortages, all that kind of stuff. However, to us, the trade, we started going short Tesla around $200, $210. We closed it around $150. In full disclosure, would be nice to still be short here. But to me, it's also kind of reached the profit targets that I've been talking about. I had sort of a 140 to 100 range. We're now right towards the lower end of that range, and I think at the latest here to us, if I wasn't already out, I'd be getting out now. The stock can certainly go lower, but things tend to overshoot. I would argue that Tesla probably overshot as it got above $300. It might undershoot here and go below $100. But a lot of this is really positioning, and fundamentals are one thing. Positioning here is probably the bigger thing. A lot of people that are believers in Tesla. And, if you look at when a lot of people started buying Tesla, which was during the pandemic, which is roughly where we're now back at. We're back at the summer of the pandemic of 2020. And so I think a lot of people are not going to break even. They don't want to lose a lot of money. So, getting out here makes a lot of sense. But I do think actually Tesla, the reward to risk on the downside is getting a lot worse now. So I'd rather start looking at playing this alongside. And full disclosure, I've got some bullish put spreads on and options way out of the money, just to take advantage of the implied volatility. But this one I think has come a long way to the downside, so it may start to get exhausted over the coming weeks or so.
Okay, just want to follow up on one other area, if I can. Talking to IG clients, always the subject of gold comes up, and indeed, in fact, it's more now at the moment because this rally or this trend that we're in at the moment, and it happens to be a rally. Yep. Are you satisfied about running this further on up?
Yes, I think we can look at gold and talk about the structural reasons to be long. In this environment of still high inflation and slowing growth, and all the reasons to own it. I'd like to give you another spin on it in terms of its performance, how it's been acting versus different asset classes. So what I'm using ETFs to keep it simple. We could use the actual futures and all that stuff. What I'm doing here is I just literally took gold as an ETF that represents gold in dollars, and I divided it by the S&P 500 ETF. Structurally, or I guess technically as the better, but structurally from a technical perspective, this is starting to act really, really well. An idea of relative strength of gold versus bonds, and this is a really extreme example. And again, I'm just going to basically look at the GLD ETF, which represents dollars and gold in dollar terms versus bonds. We're having a hell of a time right now in terms of gold versus bonds. So I think that relative strength will continue versus bonds. I think that's going to start looking less attractive. But in absolute terms, and I'm going to flip over to the futures chart here on gold. I think in absolute terms, gold remains something where we certainly want to be. This is not gold. We want to be bullish on as we continue to push deeper into 2023. I ultimately think it shouldn't be that hard to get gold back to its 2,200 or so, and I think it's really just starting to move. Gold doesn't usually move in a linear fashion until it does, and I think if you look at the charts of 2006, 2010 or so, that's a pretty good example of that.
Interesting. Okay, all right. Look, Serge, we'll leave it there. But thanks indeed for your time as we start out in 2023. It's a pleasure to be able to catch up with you. Thank you. That's Serge Berger. He's there with us from the steadytrader.com.